Welcome to Chapter 3 on inflation. So we're just really going to go ahead and get started here. Last time we met, we talked about GDP. But when I was talking about it, I left some stuff out. And I left it out because it was really just... I think it's better to have it in this chapter rather than in the previous chapter on GDP. Because there's actually two types of GDP that we're going to be playing around with in this course. The first one's nominal GDP, which is what you learned last week. The other is real GDP. And the difference is the time period in which the price component is included. Nominal GDP has current prices and current quantities. So if you look, YT equals PT times QT. Well, PT, price in time period T, times QT, quantity in time period T. So for nominal GDP, you would have current prices, current quantities. Real GDP is a little different, right? Real GDP is going to control for the price change by cutting out the role that changes in the price level have on nominal GDP. But before we really go any further with that, we need to know what a change in the price level is. Well, that change in the price level, or the increase in the price level, is what's known as inflation. Inflation is an increase in the average price level over time. So you can think of it as like the constant erosion of the purchasing power of your dollar, because your dollar last year could have bought more than your dollar can right now, because prices are always increasing. So you can really think of it as the percent change in the price level between two periods. So inflation is a rate of change of prices, but there are multiple things that can be causing that rate of change of prices. What are some of the things that can cause it? Well, first, the central bank using expansionary monetary policy. We'll get much further. We'll get further into that one later on in the course. The second could be a change in market expectations about the price level. Basically, everybody expects inflation to increase, and it becomes sort of like a self-fulfilling prophecy. There could be preference shocks, right? You could demand more of one thing, less of another, and then as such, that can trigger an increase in inflation. There can also be a cost push shock, and that would be like a change in the factor price of production, like, say, a minimum wage hike, right? If wages were to increase substantially enough, well, the cost of production increase. The firm has to pay more in order to be able to produce. And in order to make up for those losses, what do they have to do? Well, they've got to increase their prices. So as they increase their prices, boom, you see a cost push shock. So if it can come from like a bunch of these different places, and that means it's probably happening a lot, or maybe like, all the time, which it is. And if it is, well, we need to talk about real and nominal variables, namely how to switch between the two. So really, I guess before we go any further, how do we measure inflation? Well, I said it was the percent change in prices over time, right? So really, it means we've got two price levels that we'd want to look at. There's the current price level and then the previous period's price level. Now, you could also, it doesn't have to be just the last period. It could be, say, last year's, right? So if it's quarterly, it could be P sub T minus 4. If it's annual, it could be P sub T minus 12, right? The previous period's previous period's price level, sound it out, Jeremy. P sub T minus N, where N's an integer equal to or just larger than 1. So as such, we would compute inflation. I'm just doing the current and immediately preceding time periods, where inflation pi would be equal to PT minus 1 over PT minus 1. So it's really using that formula new minus old over old. So it's a percent change, right? So now from this PT minus 1 over PT minus 1, what we can do is we can separate out the fractions. Remember, you can separate out the numerator, you just can't split up the denominators. So if we split the numerator, we get inflation, pi t, equals PT over PT minus 1 minus PT minus 1 over PT minus 1. All right, well, anything divided by itself is just equal to 1. So if we look at equation 6, we get inflation equals PT over PT minus 1 minus 1. And then from that, all I do is I just add 1 to both sides of that equation. It gives me equation 8, 1 plus pi t equals pt over pt minus 1. So 1 plus the rate of inflation is equal to the new price divided by the old price. You're going to want to hold on to that. That's a very, very important formula throughout the remainder of this course. So a nominal variable doesn't account for any changes in the price level. And real variables do account for changes in the price level. And we will be playing with this with GDP to be able to tell the difference between nominal and real GDP, because real variables will hold the price level fixed. Nominal variables don't. From nominal variables, you really get two moving variables inside, right? Because nominal GDP has price moving around and it's got quantity moving around, right? And if you want to think about this from like a scientific approach, we don't want two moving parts. It's too much to have to lock down at any one point in time, right? You want to have something that's kind of fixed and something that moves around, but you don't want to have too many things moving around. So we got to find a way to lock down that change in prices so that we can get an idea of how output's changing over time, regardless of the change in prices. Because if we don't do that, well, GDP could increase, but is it increasing because the price level increased, or is it increasing because production actually increased? But for real GDP, when we look at that, what we actually have is, say, if real GDP were to go up, well, prices are held constant, which means that output, only production, is going up. And that way we can go, okay, yeah, GDP either went up or it went down. So here's like another way to think about it, right? If you remember, like, what is Algebra 1, I think it was Algebra 2 in high school, at least it was for me. That was like, a millennia ago. You remember having like multiple equations, you had like systems of equations? Well, imagine having one equation with two unknowns, right? You can't solve for those two unknowns. You can only solve for one of the unknowns if you have one equation. So if you got one equation and one unknown, then we can uniquely solve for what that unknown is. Thus, there's no identification problem where the solution for one variable depends on another, for which, we don't have enough information to pin down the behavior. We don't have to worry about any of that stuff, right? One equation, one unknown. So with that out of the way, let's see how to get real GDP. So to get real GDP, we need to start with nominal GDP, right? But instead of multiplying quantity by the current price level, we're going to multiply quantity by a base period's price level, call it P sub 0. Now, that doesn't mean that the current year can't be the base year, but what it does mean is that we're going to be using that base year for every other period to get real GDP. So the base period's real GDP is equal to nominal GDP for that period. So if that's the case, right, we would have PT times QT, or P sub 0 times QT, right? Now notice the left-hand sides of equation 10 and 11 are a little different, right? The left-hand side of equation 10 is a capital Y. Left-hand side of equation 11 is a lowercase y. Why is that? Well, that's because any variable that's in lowercase is a real variable. Any variable that's uppercase is treated as a nominal variable. It's another thing you're going to want to remember throughout the remainder of this course. So when it comes to finding inflation, there are a bunch of different ways to find it, right? It's not just that one thing that I showed you. Because there are different price levels that we can use. And we'll learn, and, really, the first that we're going to learn is the only one that we're going to be computing ourselves, at least right now, is the GDP deflator. And we can compute the GDP deflator by computing nominal GDP and dividing it by real GDP. And that's going to give us the inflation rate. So let's say we look at this set of goods with prices for 2018 and 2019. All right, so I got a couple of goods and I've got prices and quantities for both years. Now I want to know what nominal GDP is for 2019. So what do? Well, I just do price times quantity plus price times quantity, so on and so forth, and I get 2543. But now I need real GDP for 2019 using 2018 as the base year. So if you look, right, I'm still using 2019 quantities, but I'm using 2018 prices. So over here, 2019 quantities right? That last column times 2018 prices, which is that first column. And when I do that, I get 1912. So what I do is I will then take 2543 divided by 1912, and that's going to give me 1 plus the inflation rate. Right? So 2543 over 1912 equals 1.3. But remember, it's 1 plus the inflation rate, right? I just want to know what the inflation rate is. So I've got to subtract 1 from both sides there, right? Which gives me 0.33 or 33% inflation. Now remember here, you're always going to want to subtract 1 from both sides when you're computing the inflation rate using the GDP deflator, because otherwise you'll see inflation's like 133%. When that's not the case. It was only 33%. So always remember to subtract 1 from both sides when computing inflation this way. Now, that gave us real GDP in levels, but sometimes we want to get real GDP in growth rates. And the math really isn't all that different, to be honest. Okay, it's a little different, but I don't know, not really. As I'm deriving it, it looks different. At the end, it's actually pretty much the same. So how do we do it in rates rather than levels? Well, this is where natural logs come into play. We're going to take the natural logarithm to get the equation to be additively separable. And then I take the first difference of the natural log, which then just gives me percent changes. So the percent change in nominal GDP is equal to the percent change in prices plus the percent change in actual output. Now remember, the percent change in prices is inflation. So really, the percent change in nominal GDP is equal to the inflation rate plus the percent change in the quantity. All right, so if we subtract the inflation rate from this percent change in YT, this percent delta YT, right, I get percent change in quantity equals percent change in YT minus inflation. Now, real GDP uses a fixed price, right? So P sub T equals P sub T minus 1 equals P0. So the percent change in prices is 0, right? In which case the percent change in this lowercase yt is equal to the percent change in the quantity. Right? So you could sort of think of it like the percent change in real GDP is the growth rate in real GDP. So when we're looking at equation 15, right, if you have a 0 inflation rate, right, then that percent change in QT becomes the percent change, or this percent change in YT over here becomes the percent change in real GDP. All right, so really the percent change in real GDP is this percent change in output or quantity, like the real things that are actually produced. Now, moving along, there's a couple of problems with inflation aside from the fact that it sucks. Now, the first is that we don't really know how to get an actual true measure of inflation. Because if we were to go out and we were to sample like all the prices, some would be relevant for us and some wouldn't, right? Think about like what the average consumer buys. Well, there's a lot of things that the average consumer isn't going to buy, right? Your average consumer isn't going to be concerned about buying a Fractal Audio AXFX3. So maybe the price for that isn't going to be included in this sample of prices that we're interested in. So what we're going to do is we're going to sample some of these prices, the ones that are generally relevant for like an average consumer, and we're going to put them into a price basket. And this price basket forms an index of prices of particular goods and services, which then gives us an estimate of inflation. But if we have different goods and services, that's going to imply we have different price baskets, which means different price indices. Now, the one that you've likely heard of the most is called the Consumer Price Index, or the CPI. This uses a set of goods most typically bought by the average consumer. There's also the Personal Consumption Expenditures Price Index, or PCE. This is what the Federal Reserve uses when they're trying to monitor inflation. So, right now you're probably going, hey, what the hell's the difference between the two? Well, they each use a chain weighting system that allows for changes in preferences over time so that some goods eventually get phased out, right? So the CPI and PCE used, say, old tube TVs in the 1980s and 1990s, but nobody really uses those anymore, right? We use those nice flat screen HD TVs. So as those guys started to take over and old tube TVs got phased out, well, the prices of HD TVs ended up in there. So it doesn't just allow for changes in preferences, it also allows for changes in technology. So what makes these two price indices different? Well, each index uses a different way that they use these chain weights. Now, there's also what's known as a core measure of inflation. Core inflation removes food and oil prices from the price indices. So core PCE or core CPI inflation look at consumer goods prices, but they leave out gas and food. And you're probably wondering, like, why the hell would they do that? Like, are they trying to cheat something? Are they trying to get around something else? Well, not really. The reason that they leave that out is actually a very good, justifiable one. First, it removes a lot of volatility in the price levels, and thus it removes volatility in the inflation rates. Because prices in food and gas can change constantly. If you go look at gas prices, right, you're just driving around, you go past a gas station, say you monitor what the gas price is every single day. Those prices are bouncing all over the place. Sometimes they're really high, sometimes they're kind of low. They generally follow like relatively slow moving trends, but they bounce around a lot. So if we want to know what the underlying kind of more like long run inflation trends prior to changes in food and gas prices are, then we might want to strip out food and gas prices. So that's why we're going to be using core rather than what's known as headline CPI or PCE inflation. Now, the Federal Reserve, right, they look at core PCE to determine inflation in the United States. And when they do that, right, they want to have a target inflation rate that their monetary policy is going to reach. And that's currently a 2% target inflation rate. So they want like an annual 2% rate of inflation. Sometimes it can be a little higher, sometimes it can be a little lower, but they want, when averaged out annually, they want it to be about 2%. So if we were to plot out first core CPI and PCE, this is what we would get. So between 1985 and 2023, if we look at these two measures of inflation, well, this is what we have. There are periods where it's a little high, periods where it's a little low. If we were to look at, say, I don't know, the last couple years, well, it's been particularly elevated, right? Hasn't been that high, well, really, since the early 1990s, if you take a look here. So, well, why is that? Well, I don't want to get super into that right now, but it has something to do with COVID and the Federal Reserve engaging in incredibly loose monetary policy for way longer than they probably should have. So this is core CPI and PCE inflation, right? Now take a look at headline CPI and PCE. Well, periods where it's a little bit higher, right? If you look at 2022-ish, it's a little elevated above what it is for core inflation. But if you also notice, it bounces around a lot. Why is that? Well, that's because of the effect that food and gas prices are having on these overall price indices. So if you're trying to use something like monetary policy, which has it takes time for monetary policy to take effect. You want to be looking at changes in trends that generally move at about the same frequency that you would expect monetary policy to take effect as well. So if you look at core CPI and PCE inflation, it's a little bit steadier, right? It's a little less volatile. I mean, yeah, you still get like those little short-term wiggles, but you could easily draw like some curves through it to try to, sort of map it out in like a smoother sense. And it would be a lot easier to do than, say, headline CPI and PCE inflation. So the Federal Reserve wants to look at core inflation because it's a little more stable, it's slower moving, and not slower moving, but the items in there, the price changes are a little bit, slower to respond than, say, food and gas prices. So they'll base their decisions on changes in core inflation rather than headline. But when it comes to that, that's much, much, much later in the course when you get into business cycle stuff. But for now, basic explanation for why the Federal Reserve uses core over headline. So another thing about inflation that sucks. Well, these price indices don't really account for changes in spending behavior that well, right? The third thing is, well, they don't account for technological change all that well. They try to, and sometimes they sort of do, but not that well. And CPI can't account for a relative price change. It's what's known as a substitution bias. So let's look at this indifference map, right? These are two indifference curves. And let's say you can buy good X1 or good X2. Well, this green curve here represents a level of like happiness, right? This is how happy you are. At any point on this green curve IC1, whether you consume this much X2 and this much X1 or this much X1, this much X2, doesn't really matter because your level of happiness is the same. Now up here, we've got a higher level of happiness. And this level of happiness similarly represents any combination of X1 or X2 that satisfies this green curve. Now, I'm going to get into a little bit of math for a split second here. Don't worry, you don't have to solve this stuff out. But let's say you've got this utility function that represents what you have for these green curves here. And you've got a budget constraint, right? So you make like, $100 a month and you can spend certain amounts of your income on X1, certain amounts of income on X2. And what I really want to do is eventually get a demand curve, because then we'll get the relationship of prices of a good and the quantity of that good. And to do that, we need to get the optimal quantities of X1 and X2 by finding a point of tangency within the budget constraint. And that point of tangency is really going to be what tells us about the substitution bias. So this point of tangency, right, this pink line, this is the budget constraint. This is this guy right here, plotted out. So when we plot that guy out, where it touches this curve at only one point, that's the point of tangency. And at this point, this is going to be the optimal amount of X2 and the optimal amount of X1 that we're going to want to consume. So this matters because we want to see what the effect of a price change is. Namely, how does a consumer spending behavior change as the price changes? And we do some more scary math. It gives us this funny sounding thing called the Sluty decomposition. It decomposes a price change into two different effects. We get the substitution effect and we get the income effect. Now, the total effect is the sum of these two effects. I'm not going to talk about the income effect, but it can be either positive or negative. But the substitution effect is always, always, always going to be negative because that indifference curve, right, this green curve here, it's downward sloping everywhere. I'm not going to make you prove it's downward sloping or anything. Just take my word for it. It's downward sloping everywhere. So if that budget constraint were to change, if, say, prices of relative goods were to change, and the slope of that pink line changes, well, the point of tangency changes. Where if there's an increase in the prices, right, say an increase in the price of, say, X1, you will consume less of X1 and comparatively more of X2, likely more of X2. So the indifference curve is always going to be downward sloping. And the substitution effect takes over where, say, you will consume less of X1 and more of X2. You're substituting away from X1 towards X2. So if the substitution effect is negative and CPI can't account for the substitution effect, do you think it over or understates inflation? I'll give you a second. Go ahead and push pause on the video. Think about it. And then when you think you have an answer, go ahead and push play and see if it is, in fact, correct. Right? So this is what the substitution effect would look like. Right? If the price of X1 changes, right, that budget constraint slope changes. Well, let's say the price of X1 went up. If that's the case, you consume less of X1, and then you'll consume more of X2. Okay, so here's the answer to the question that I asked. the price of X1 goes up, you want less of X1, more of X2. That's called the substitution effect. But the CPI or PCE don't account for that. And this is what's called the substitution bias. And if it can't account for that, then the CPI has to overstate inflation because substitution effect is always going to be negative. So remember when I said the Fed aimed for like a 2% target inflation rate? Well, it's because they estimate the substitution effect at about 2%. So if you can reach a 2% inflation rate, you probably have pretty stable prices over the short to medium run. So let's talk a little bit more about inflation, more stuff. So inflation is a tax. Now, how is it a tax? Because you think taxes are like, you get paid and they remove the money from your paycheck, right? So how is inflation a tax? Well, let's say the economy gets hit with 5% inflation one year. Everybody eventually has to get a raise to maintain that same purchasing power. But what happens if the government doesn't raise their marginal tax brackets? Well, everyone ends up paying more in taxes to the government. Now, that doesn't always happen. At least the thing about the government not raising their marginal tax brackets, because they usually do that. So for 2022 to 2023, they were raised by like 6%, give or take, depending on what the brackets are. But inflation in 2022 was 8%. So even though they raised the tax brackets, they didn't raise the tax brackets by an amount equal to that of inflation. So we ended up paying more in taxes because of high inflation. Isn't that lovely? There's a bit more worth mentioning, right? Inflation transfers wealth. It redistributes wealth from lenders to buyers. So if you borrow $100 and you pay it back over the course of a year, and the interest rate is 3%, but the inflation rate's 5%, it transfers wealth from the lender over to the borrower because in real terms, you actually end up paying back less. Nominally, you still pay back $100 plus the 3% interest. But in real terms, because inflation's eroding away the purchasing power of that money, you end up paying back less in real terms than what you borrowed. How does this work? Well, to do this, we need to find a way to convert between real and nominal variables. Fortunately for us, we already have that. So remember when I talked about looking at real nominal GDP growth in rates and how we subtracted inflation from nominal GDP growth to get real GDP growth? Well, it's an application of what is referred to as the Fisher equation. And the Fisher equation is given by equation 18, where the nominal interest rate, capital R, is the interest that you are quoted when you take out a loan, right? The real interest rate is the interest rate that's paid/earned once controlling for inflation. So the nominal interest rate is equal to inflation plus the real rate of interest. So let's say you took out that $100 loan. When the nominal interest rate is 3%, inflation's 5%, by the Fisher equation, right, you would get 0.03 equals 0.05 plus the real interest rate. Well, what's the real interest rate here? Well, you got to solve for it. You get the real interest rate being equal to 0.03. It's supposed to be minus 0.05, not equal 0.05. There's a little oopsie there. So you get a real interest rate of negative 2%, which means that in real terms, you end up repaying $103 in that $100 loan that you borrowed. But that $100 is actually worth $105 in 1 year, which sucks if you're a lender because you actually lose out on purchasing power when you're getting repaid. Now, this is where like monetary policy stuff comes into play. And without getting too far into how it works, essentially the Federal Reserve buys treasury securities, government debt, on the open market. And they do this to try to convert illiquid assets that banks are holding. There's treasuries, right? These government bonds. They want to convert that into a liquid asset, which is cash. And they do this by creating excess reserve balances and then using them to buy treasuries, which gives the bank more liquidity. Now, the interest rate used by the Federal Reserve Bank is what's known as the Fed funds rate, and it's the overnight lending rate between banks on excess reserves. And the Fed sets a reserve ratio requirement, meaning if a bank has, say, X dollars of reserves, they need to hold on to some share S% of those reserves in case people want to come in and withdraw their money from the accounts, right? So if a bank, gets $1 million deposited, they have to hold, say, 10% of that, right? So it'd be $100,000. So the bank's got to hold $100,000 in case somebody comes in and says, hey, I want to take out, I don't know, $80,000, right? Now, sometimes banks at the end of the day go, oh my God, we actually didn't meet that requirement. We thought we were gonna, but we didn't. So if they don't meet that requirement by the end of the day, they can borrow from another bank and then they'll just pay it back tomorrow and they can replenish their reserve requirements. The interest rate, that overnight interest that they'll pay, is the benchmark for almost all other interest rates in the economy. And that overnight lending rate is the federal funds rate. And that's what the Federal Reserve tries to set using their monetary policy. Now, they don't just set it by diktat. They don't just go, well, we want the Fed funds rate to be this, so it's going to be that now. They announce what they want it to be, and then they'll buy or sell treasuries to try to get it to that point. And if you don't really know what's going on with all that, don't worry. We will be getting into that in pretty good detail later on. Right, so if that's the benchmark interest rate, the Fed buys a lot of them. They, inject all these excess reserves into the banking system, which may enter the money supply, may not, depends on what happens, what the bank does with those reserves. It means if those reserves do enter the money supply, then the Fed has indirectly increased the inflation rate. Right? They don't directly control the inflation rate. They don't say, we want inflation to be this, and then it's that. It'd be nice if that was the case, because then, inflation would be nice and low. But they can only increase reserves that the banks hold. Now, if the bank wants to lend more money out, if those reserves get lent out, they now enter the money supply. And if you have more money chasing the same number of goods, what happens is the price level will go up, hence inflation. So if you hear about monetary policy, what's happening is you're essentially getting too many dollars chasing too few goods. If the inflation rate rises, then the real value of government debt has fallen. That whole, repaying your stuff back, right? If the inflation rate goes up, well, the real value that has to be paid back falls. Well, the real value of the government debt then falls, and this is what's known as monetizing the debt. Now, it's done somewhat frequently, basically anytime there's inflation, but it's not done intentionally, right? It's not like they're going, we want to monetize the debt, so we're going to increase inflation to like 10%, because that's going to screw everybody over. Doesn't make anybody better off. It's more done indirectly. They're not trying to do that, but it just sort of happens as a result of monetary policy. So it'll happen sometimes because, say, the Fed has some other goal in mind, and this is kind of a byproduct, not the initial intent of that policy. Now, monetizing the debt can make it easier for the federal government to pay back their debt because, well, the inflation rate has increased, and it's thus reduced the real interest rate. So instead of paying back $1 trillion, they might pay something like $0.98 trillion. But this can't be overused. Why? Well, if it is, then the Fed runs the risk of what's known as hyperinflation. Now, there are many different cutoffs for what actually triggers hyperinflation, right? Different definitions of hyperinflation. But the one I'm going to go with is a rate of inflation accelerating so rapidly that it exceeds a monthly inflation rate of 50%. At this point, prices are increasing faster than anyone can keep up with them. Now, this happened most recently in Venezuela, at least as of the last time that I typed up this lecture, which this lecture was originally typed up in 2020. But the IMF projected that by the end of 2019, you would have a, 10 million% inflation rate in Venezuela. And at that point, the currency becomes useless and a number of things start to happen. So what happens? Well, first, the population stores wealth in non-monetary assets, or like an alternative currency. Say they'll hold euros instead of whatever their currency is, or they'll hold dollars instead. Second, any holdings of local currency are immediately spent to maintain the purchasing power. You're not saving anything because there's a negative rate of return on saving, right? And recall that savings are equal to investment. So if there's no saving, well, there's no investment. You're getting some big, pretty nasty issues here. Third, The population sees money amounts in terms of another currency instead of their own local currency. And then fourth, sales involving credit take place at a price that are projected for what the price will be in the future and are thus wildly overinflated. The purchasing power eventually just gets obliterated. Savings go to zero. You start hoarding stuff like gold and silver, and then you'll get capital flight, people moving their capital overseas because they'll lose out by less if they do so. Overall, hyperinflation is just an absolutely terrible, terrible, terrible thing, and it can completely wreck an economy, and it can cause a currency collapse. Now, that is going to wrap up the lecture on inflation. This wraps up Chapter 3. We'll be starting Chapter 4 on, the next lecture, which will be Thursday of this week. And that will be unemployment and labor market stuff. So thank you for watching, and I will see you in about a day.